Hello, friends. Welcome to Akulmach Live. Are you a business owner or an entrepreneur in India looking to understand the latest GST rate changes? The new GST rates are the golden opportunity for your business to not only save money but also boost profitability. But how exactly do you take advantage of these reforms? Let's go and find out in the long form video. Hello, everyone, and welcome back to the channel. Today, we are diving deep into a topic that could literally transform your business's financial health. How to maximize your profit with this new GST rates in India. So, if you're an entrepreneur, a small business owner, or even if you manage finances of a large enterprise, you know that navigating India's tax landscape, especially GST, can feel like a complex maze. But what if I told you that the latest GST rate changes aren't just another compliance headache, but actually a golden opportunity, an opportunity to save money, streamline operations, and most importantly, boost your bottom lines like never before. That's right. The recent adjustment by the GST councils are designed to bring significant benefit to various sectors, and understanding them is crucial to unlock those advantages. In this comprehensive guide, we are going to break down everything you need to know. So let's kick things off with the foundation. Understanding the new GST structure. It is important to remember that GST, or Goods and Services Tax, is a multi stage, destination based consumption tax. Its primary goal when introduced was to simplify India's indirect tax regime. And while it has evolved, its core principle remains the same. The GST Council periodically reviews and revises the rates on various goods and services. These revisions can be influenced by several factors, starting with the economic conditions and to stimulate demand or to control inflation. Next is the industry representation. So, time to time, feedback from various sectors asking for relief, based on their recommendations, the GST slab revisions happen. Then also based on the revenue collection, adjustment to ensure stability for states and central government based on how much split is there between the two, etc. And also a fourth reason could be simplification. So further refining the tax structure to reduce compliance burden, etc. for common man. So what exactly has changed recently? Well, specific rate change frequently. The general trends we have seen in recent major update often involves: number one is the rationalization of the slabs, moving item from higher tax bracket to lower ones, especially for the essential goods or services that have seen increased demand or are part of the government initiative. Number two is the exemption and inclusions. Certain items might get exempted, or new services might be brought under GST net, usually at a lower rate initially, and then subsequently it will be relooked at. And the third point that the current GST regime has changed is the clarification on HSN and SAC codes. Sometimes it's not the rate that changes but the classification, which can indirectly affect the applicable tax rate. The key takeaway here is that these changes are generally aimed at two things: easing the burden on consumer for certain goods and services, and providing boost to specific industries. And that's where your opportunity lies. Now that we have basic understanding of what has shifted, let's move on to the exciting part: how these changes can directly translate into savings for your business. And this is where the rubber meets the road. Understanding the new rate is one thing, leveraging them is another. Here are the practical strategies to identify and capitalize on the latest GST changes for tax saving. Strategy 1 is about re-evaluating your input tax credit, also known as ITC. And what is the change this time? Now, the GST rates on your raw material component or services used in your business have been reduced, your cost of acquisition might go down. The action that you need to take is basically relook at this specific to your industry. Don't just assume your software can handle things. Regularly review the GST rates on your purchases, inputs, capital goods, and input services. Ensure your vendors are charging you the correct updated GST, and overcharge GST even if claimed as an ITC means higher cash flow initially. More importantly, if your output GST rate has decreased, you might end up with a higher accumulated ITC than before, which needs to be carefully managed to avoid blocking capital. Number two strategy is optimize your supply chain and vendor selection. The different times are for services, and your supply chain might now fall under different GST slabs based on what kind of business you are doing. So, are your current vendors charging you optimally? Can you source similar quality material or services from a vendor whose item now falls under a lower GST bracket? Sometimes even a slight change in the description of service or good can lead to a different GST rate. Engage with your vendors and negotiate. Make sure their invoicing is updated as per the new rates. And lastly, the strategy 3 is review the product and services classification, which are known as HSN and SEC codes. Sometimes the government clarify and reclassify certain goods and services, and therefore this is an important step. Double check the HSN, which stands for Harmonized System of Nomenclature for Goods, and SEC, which is Services Accounting Code for services you deal in. A misclassification could lead to paying higher GST unnecessarily, or worse, non-compliance penalties. Consult with GST experts if you are unsure about the correct classification for any of your offerings, especially if there are some niche areas or hybrid businesses that you're in. Strategy 4 is leverage exemptions or reverse charge mechanism, RCM. So some items or services might have moved into an exempt category, or there might be a change in the applicability of the reverse charge mechanism. So if your business deals with newly exempted goods or services, ensure your billing reflects this correctly. For RCM, always to stay updated. If a service you procure now falls under the RCM, you as the recipient becomes the liable to pay the tax directly to the government, which can affect your cash flow. Even though ITC can often be claimed later, be aware of these nuances because it is important, otherwise your capital will be locked up. Strategy 5 is analyze the impact on your cash flow. Lower GST rates on your output means less tax collected from the customer and potentially less paid to the government, right? So this can be a double-edged sword. While it might make your product more attractive, ensure your ITC claims are robust to manage your cash flow effectively. If your ITC balance starts accumulating significantly, it means your capital is locked up. Explore options for faster ITC refund if eligible and available for your sector. Regularly reconcile your GSTR 24A and 24B with your purchase register. These strategies aren't just theoretical. They require active monitoring and quick adaptation. The businesses that stay agile and informed are the ones that will truly reap the benefit. Now let's look at how these rate changes can be used strategically in your pricing decisions to boost sale and profit. Pricing is an art and also a science, and new GST rates offer a fresh canvas. When GST rates changes, you have a critical decisions to make. Do you pass on savings to your customer, or absorb them, or strategically adjust based on the conditions? So let's look at different options. Option one is passing the savings to the customer. That means reducing your MRP. If the rate reduction is significant and you operate in a highly competitive market, this can increase sales volume, capture market share, and attract new customers. Higher sales volume can lead to greater overall profit. Even if the per unit profit margin is slightly smaller, it also fosters goodwill and the perception about your product, which increases the value. Now, option two is you want to absorb a part or all of the savings, which is maintaining current MRP. So, what will happen if your profit margins were thin, or if the rate reduction is minor and unlikely to significantly impact customer purchasing decision? Then this is the option that you must go for. Directly increase your per unit profit margins, boosting your bottom lines without needing to increase sales volume. This is a direct profit maximization strategy. And option 3, which is the most optimum, and that is the strategic price adjustment hybrid approach. This is often the most nuanced and effective. You might pass on some of the savings to the customer to remain competitive while absorbing rest to improve your margins. Balances increase sales volume, will improve profitability, allows for flexibility in marketing and customer perception are the clear benefit that you may get it. Now, before we move further, let's discuss certain key consideration for pricing. Number one is the competitive landscape. You have to understand what are your competitors doing. If they pass on the savings, you might need to do so also. If they don't, you may have more leeway. Second is the price elasticity of demand. So how sensitive are your customers to price change? For highly elastic products which demand change, a lot of change with the pricing, passing on savings can dramatically boost sales. For inelastic products, you might be able to absorb more savings. Number 3 is the brand value. A premium brand might choose to maintain price and emphasize quality, while the value driven brand might focus on passing the savings. So, you need to understand which type of brand you are building and accordingly price it. Number 4 is your operational cost. So, have your other operational costs like raw material, labor, logistics, etc., has undergone some change? Factors those into your net pricing decision. Remember, the goal isn't just to react to the GST change, but to strategically use them to your advantage. A well thought out pricing strategy can be a difference between merely surviving and truly thriving. Now, let's zoom out a bit and look at how these rate changes affect different sectors and what you should be mindful of. So, GST rate changes rarely operate in vacuum. They create ripple effects across the economy, impacting various sectors differently. Understanding this broader context can help you anticipate market shift and position your business strategically. So, what are the common beneficiary of the rate reduction? Uh, First is the manufacturing sector, which often sees relief on raw material or components, leading to lower production costs. This can make their product more competitive in the market. Next is the retail sector. Lower GST on consumer goods can lead to increased purchasing power and higher sales volume, especially for discretionary spending. Number 3 is the hospitality and tourism, which often receive specific rate cuts for services to boost this sector, especially after economic downturn. Number 4 is the construction and housing. Reduced GST on construction material can lower project cost, potentially making housing more affordable and stimulating demand. And lastly, the MSME segment, which is the micro, small, medium enterprise. Government often targets these businesses with simplified compliance or lower rate to encourage growth and employment. And there are a lot of areas because of GST change. There could be some potential challenges, starting with the accumulated ITC. Some sectors, especially those with the inverted duty structure, where the input GST is higher than the output GST, might see increased accumulation of ITC, tying up working capital. Number two is a transition period. Any change creates a transition period with potential for confusion in invoicing, compliances, and accounting. Be proactive in updating your system and training your staff. Number three is competitive pressure. So, if your competitors quickly adapt to the new rates and you don't, you might lose out the market. So, what are the overall steps that you must take while the GST rate reduction is going to kick in on September 22nd? Starting with, stay informed about your sector. Don't just overlook that, because you need to know exactly how your sector is getting affected, right? Number two is monitor economic indicators. Keep an eye on consumer spending patterns, inflation rates, and overall economic growth. These broader trends will influence how effective the JC rate changes are in stimulating demand for your product or services. And also, network with peers. Talk to other businesses and other owners in your industry. Share insights and best practices on how they are adapting to the new GST rates. This can provide invaluable real world perspective. The landscape is always shifting, but you need to be aware, and you have to be proactive in planning. You can turn these shifts into stepping stones for your business growth. And lastly, before we wrap up, have a quick chat with your accountant or tax advisor to understand specific implications of your business model. So, friends, I have been able to explain what you need to do and how you need to do, considering that the GST rates are going to kick in on September 22nd of this year, few days from now, maybe 2 weeks from now. And therefore, if you follow these guidelines, you will be ready for September 22nd. Friends, if you found this video helpful, please give us a thumbs up, subscribe to the channel for more valuable business insights, and hit the notification bell so you don't miss out on any of our next upload. Thanks for watching, and I will catch you again in the next one.